Welcome, everyone. I'm Erwin, Executive Director of the New York Technology Council. I'd like to welcome you to tonight's event. Delighted to be in this space and have tonight's program and to have all of you here. Over half of you are not members of the council, and so I thought I'd tell you a very little bit about it. We're a nonprofit association here in New York. Our mission is to support the tech industry here. New York being whatever you want it to be. We draw from Westchester and Long Island and New Jersey as well as the city itself. We focus on four things. One is information and education. Events like tonight typify that aspect of what we do. Providing networking opportunities, another one. The talks tonight will be followed by a reception upstairs, and we hope you stick around for that and get to know each other. The third aspect of what we do is work with many organizations throughout the community here in New York. It's a very large and diverse tech community, and so no one organization covers it all, so we work with as many of the organizations in town as we have time to work with. And the fourth is policy advocacy. Right now we're focusing on immigration reform and tech, a very hot topic at the moment. And we'll be moving on. Hopefully that will get settled soon, and we'll move on. I think there's lots to be done with privacy, and so that will become more of a focus going forward. I'd like to thank our annual sponsors. It may sound trite, but without them we would not be here tonight. And I'd like to welcome PwC to this list. They're a relatively new annual sponsor of ours, so thank you. As I mentioned, we work with a number of partner organizations. This is a partial list, and it's growing. Let me mention some upcoming events. On the 26th, we've got a book talk in our author series on gamification. Then the next night, the 25th. The next night on the 26th, we've got a discussion of big data in the cloud. And then on Thursday, we have the final in our four-part series on mobile UX design. And then we'll go into other UX issues when we come back after our summer break. And then on July 16th, we have our summer networking party. Thank you. Sorry if you couldn't hear me. I am not going to start over. I would urge all of you, if you consider yourselves to be with an important tech company in New York, to consider becoming a sponsor of the organization. We can always use more sponsors, and the more support we have, the more we can do for the community. And with that, let me move into, let me again give a special thanks to PwC for hosting tonight's event. They're also providing the refreshments afterwards. And let's start. Let me go back to first chart. And next up is Charles Anderson from PwC. I'm sorry, David Silverman from PwC, who will be moderating tonight's event, and he'll be introducing the rest of the evening. So thanks again for coming.
Good evening, and welcome to the PwC auditorium. And so happy that you can all be here, and happy to be hosting another New York Tech event. We were involved early on in the organization's beginning and hosted a number of really good events with them, including one very similar to this, and we figured let's recreate the magic. And I think tonight's crowd is even bigger and better, and last time we had a great panel, but tonight's panel is absolutely top-notch, so I think it's going to be a great event. We're going to kick off, I don't know how many of you are familiar with our Money Tree, but it's a survey that we do on a quarterly basis, tracking venture capital financing in the United States. It's going to give a lot of good facts and figures. My colleague Charles Anderson is going to present it. I'm sure there's a lot of data there. We'll go quickly, but generally the themes are what we're looking for. You'll have ability to get access to the data at a later point. And then we'll use that kind of as a launching point to help the panel discussion. We'll leave some time at the end of the panel discussion for questions from the audience, and then also equally important, we'll leave time to make sure that we've got time for networking and some cocktails upstairs as well. So with that, I'm going to turn it over to Charles.
All right. Thanks for the introduction, David and Eric, and pleased to be hosting everyone here tonight. I want to talk quickly about the PwC Money Tree report. This is the Scottish version. Just to outline some of the rules. Everything has rules. So this is a survey that's been ongoing for 18 years now. The data is sourced by Thomson Reuters. So it's a national gathering of data. As David says, it really gives some good insight into what's happening in terms of VC investing trends. And what that means is it's actual tranche investment, so it doesn't include debt or bridge loans or other deals. So really focusing on the VC financing trends. So with that said, let's actually jump into some of the numbers. Hopefully everyone can kind of see the trends, if not the detailed numbers. What we're actually seeing for the first quarter of 2013 is a number of just below 6 billion. So kind of comparable with Q1 2012, slightly down from Q1 2011. On a general theme, we've been seeing some progress coming from 2009 through 2012, but still not back up at the levels that we saw in 08 and 07. But still some positive signs there. And then along the bottom, we've got the number of deals as well. So obviously a good amount of activity, just below 1,000 deals nationally. What this chart shows is the annual activity. So you can really take from this and see that over the last 10 years or so that we have been in the kind of 20 to 30 million range. So something that's in the mid-20s up to the $30 billion is a good year. At the moment we're tracking at 6 billion. So if we annualize that and get somewhere in the mid-20s, that would be a nice number to achieve. And that this just shows the level of activity or lack of activity going back to 1982. What this chart shows is the number of deals and the investment. So you see there that I spoke about the 5.9 billion, and actually we see there the average deal size. So on the bottom we can see that the Q1 average deal size is 6.8 million. So it's kind of consistent with where we've been, slightly down, and I'm not sure that might mean that we're seeing some less capital intensive investments, so some financing rounds are just getting a bit smaller, but still consistent with the trends that we have been seeing. And then cutting the data differently again, we can see where the money is actually going. So again, here you see that as I think everyone would expect, the money is going to Silicon Valley. That's the majority of the funding going there. If we were actually to spin this back further, you'd see that New York Metro is probably more traditionally around the 7% level in terms of national funding. So we're seeing there that the gap between New York Metro and New England is probably closing. And if we were to dig into that a bit deeper, we'd actually see that the technology investment is greater in New York Metro than in New England. The one trend that probably sticks out, and we'll see this on the next graph as well, is the level of investment in Texas, which is this networking and equipment, 7% over there. So there's one very big deal, voice over IP in a gen band in Texas that was over 300 million. So that's really kind of skewing the results there. Other trends, typically we see that biotech and med device and equipment, those combined are normally around the same level as we see in the software. So that's kind of consistent, but obviously in Q1 we see that there's a jump up in software investment activity there. This slide drills into that. So these are both within the software category, and you can actually see some of the trends, and obviously internet being very relevant to the New York market. Clean tech, we see the trend there in terms of the number of deals, and the value is continuing to tail off. On the internet side, there is a slight decrease there as well over the last few quarters, but kind of consistent with prior Q1s, not terribly different, but a slight decrease over the last few quarters there. One of the other things that we also analyze is looking at the stage of investment. So, which stage is the company at when the financing rounds are being invested? And what we're actually seeing is a trend nationally of some more later stage investment. Not always easy to tell why that is, but sometimes it's a case that the VCs are doubling down as there's a vision towards the exit strategy, and there's some more later stage investment before that exit event. Along the bottom, you'll see the small bar is the seed stage, so a slight uptick there, but also good to see that's been maintained at the seed and the early innovation level. And this really tells the kind of same story. So this is just the number of deals rather than the dollars being invested. Another thing here, looking at the number of first sequence investments, so just under $1 billion. So again, very consistent with what we saw in Q1 2012, and going back to 2010 Q1. Slightly down from where we've been, but pretty consistent again in terms of the level of dollars being invested at the first sequence stage. That's the number of deals. Probably on this graph, the thing to point out, so the overall percentages are pretty consistent in the 30s, so that's the percentage of first sequence investment as a total. But then what we're actually seeing is a trend down on the actual dollars. So while the number of deals is actually staying pretty consistent, the actual dollar value is smaller, so there's less going into the first sequence investments. And here, again, I spoke briefly before about the fact that we're seeing some later stage. So also we're seeing later stage first sequence investments. So again, a trend towards more later stage activity. This is just the later stage first sequence. This slide just shows some of the average dollar sizes. The average deal sizes and the median as well. So we're actually seeing a slight fall off there, but a kind of consistent trend over the last couple of years. So it's a who's who of who's investing. So obviously a lot of West Coast presence, and in particular in New York, we're seeing a lot of activity with first round active in New York, and we've got Bessemer in the top 10 as well, but no kind of surprises in terms of who's making the investments. This is quite an interesting slide in terms of the IPO and the M&A activity. People are always keen to know what's happening when companies are exiting and going through the IPO process. So in Q1 there was 8 IPOs, so not really a terribly hot market, and certainly cooler than where we've been previously. So I'm sure everyone's looking for some more activity there. Trending down from where we were previously. There was a blip there in 2012. Obviously, the Facebook IPO really ramping up the numbers, but Q1, I think we're seeing and we keep hearing about a lot of pent-up demand, and everyone's just waiting for that to come. And hopefully, the markets will be in a good position when companies are ready to do that exit. This slide just talks to the level of fundraising. So actually what we see in Q1 is 4 billion raised. So if we annualize that, it's tracking to 16 billion, which is going to be lower than the last couple of years. That's been coming up since 2010, which is positive, but It's tracking down at this point, although that's pretty lumpy and hard to forecast on a quarterly basis, so we need to see where that will fall out for the full year. Just drilling into the New York Metro, so all of those numbers and facts were on a national basis, but we can also peel back and look at what's happening in the New York Metro market. So we see here, so this is the total New York Metro market. 2013 so far, 600 million. So if we analyse that, it's on track to match what happened in 2012. And you can see the overall continued uptrend, which clearly is a positive trend here in the New York market. And then this is the total number of deals, so a very consistent story with the last chart. Here we look at the New York Metro percentage of national dollars and the number of deals. So we're seeing that the number of deals is going up faster than the dollars. So we've got smaller deal sizes taking place in the New York market, probably indicative of the fact there's more internet-based investments and less capital requirements, so perhaps the smaller deal sizes are getting companies through their financing requirements. And then we can also peel that back further in the New York space, so we can look at the tech specific in New York. So again, a positive trend. It's not ramping up as fast as the internet specific. So you see here that we can look at the internet specific. So while there was a more moderate increase, obviously a nice uptick there. So we're seeing a lot of activity in terms of new internet-based companies and interest in investing in those, certainly. And then we've just got a couple of charts here where you can see the spend, the investment as a percentage of the total, so the number of deals and the actual dollar values being invested as well. So you see that it moves pretty much consistently in terms of the overall national trends and what we see here in New York. And this, like the other national slide that we saw, just splitting it down into what we're seeing. So while on a national basis, we're probably seeing more later stage investment and a trend towards more later stage investment. Now we're seeing here in New York that there's probably greater early stage and expansion stage growth investment. So you see here, so this does a comparison of the expansion and later, so that's actually fairly flat, and then you see the seed and early trend line is tracking fairly consistently as well, so not huge trends to be identified there. When we're looking actually at the number of deals, we're seeing this is showing that the number of deals are actually going down on the expansion and later trend, so there's an offset there between the dollar values and actually the number of deals being done, and this one shows the flip, so this is really tracking the seed and early stage number of deals, looking over the national percentages, so a nice uptick there. And then that brings us to the overall stage of investment and really tracking what's happening in the later only stage investments. So again, an uptick that we're seeing in Q1 2013 so far. And that was the end of the Money Tree presentation. So, I mean, that was a lot of information that we went through pretty quickly. The presentation and all the data is available. And I'm not sure if it's on a handout somewhere, but that's information that you can access, or if there's any questions for myself or David, I'm happy to drill into any of the data in some more detail. Thank you.
So, I would like to introduce the panel tonight, and as I mentioned, we've got a great panel tonight. On the far end, Amish Jani, a founder and managing director at FirstMark Capital. which is one of the leading, I'm going to say one of the leading firms for all three of the firms here tonight, but it is true, they're all three of them are leading kind of institutions here in the VC space in New York. Amish is a founder and managing director of FirstMark Capital, and he focuses on seed and early stage investments in software, cloud computing, digital media, and internet sectors. And when I look over his list of portfolio companies, they're really transformative. Companies like Aereo, Newton, Lot 18, are really kind of disruptive in the industry. Next to Amish is Brad Burnham, partner over at Union Square Ventures. And Brad began his career way back in 1979 at AT&T, held a variety of positions there until 1990, when he spun Echologic out of Bell Labs, and that was considered kind of the first AT&T venture investment, and ultimately kind of was a genesis for forming AT&T Ventures, where Brad ended up coming back as an entrepreneur in residence. Brad currently serves on the boards of a number of companies, and just to show you how quickly things go out of date, the first one is Tumblr. So I don't know if you're still on the board of Tumblr, but Tumblr obviously had a very successful exit.
How about a little round of applause for a good New York win?
A number of other real exciting and interesting companies, including Meetup, Yieldmo, GetGlue, and Simulmedia. Lastly, Brian Hirsch, managing partner at Tribeca Ventures, where he's co-founder and managing partner. Brad previously was at a number of other venture firms, including GSA Venture Partners, which was formerly the arm of Greenhill. And Brian is also involved in a number of really exciting investments, including Flat World Knowledge, HomeSphere, Pontiflex, Real Direct, and Spanfiller Media Group. With that said, why don't we dive into some questions, and we'll try and leave some time at the end for some audience questions. Let me start with kind of one of the themes that I find to be interesting, and I'm sure everybody here is interested in New York. We see some diverging trends between the national investment scene and what we're seeing in New York. And I was just curious what your thoughts were. Is there something going on in New York that's not going on nationally, or vice versa, or is this data really maybe not what it might seem to be? And maybe we can start with Amish.
Well, sure. We hope so. I think many of us are in this room think about New York as this rapidly emerging ecosystem for entrepreneurship. A variety of reasons for that, but I think we're all big believers in that. And the elements that you need to sustain an ecosystem here continue to get better. Whether it's by way of acquisitions and capital flowing in, whether it's firms coming into New York funding companies. New firms starting up here, growing up, whether it's big technology companies that are trying to create and grow their presence here, and then of course the massive industries that are headquartered in New York getting disrupted. So, my belief is that New York is growing, will continue to grow disproportionately, and it's a really exciting market that I think we're all fortunate to be in at this juncture. Long way to go, but in general, I think that's the trend line we're seeing.
Just continuing down the line.
So I think it's actually a bigger phenomenon. I mean, everything that Amish said is absolutely correct, and we're in sort of our second or third generation of entrepreneurs here. We're seeing people, reinvest as angels in the community, and all that's part of building New York. But there's something else going on, which is kind of the urbanization of innovation, and you can see this globally. We have, I think, 7 or 8 companies now in the Silicon Valley, or in California, but 5 of them are up in San Francisco proper. They're not down on the peninsula. If you look at other places where really interesting stuff is happening right now, it's Berlin, it's Tel Aviv, if you look in what used to be the Research Triangle down in North Carolina, the airport is surrounded by these single-story office parks where you drive in. you do your, 8 hours and you drive home to your suburban home, and that is just completely dead. They can't rent those for anything. But in the old tobacco warehouses in downtown Durham, there's this very vibrant, lively startup community. And so I think what we're seeing is that young people are interested in a lifestyle where they can live and work in the same place, where they can walk to work, they can get a good cup of coffee, and they're not interested in being, in a cubicle and, going home to a sort of a tract house. They're interested in diversity. They're also not interested in going to a party and talking to people exclusively about technology or startups. They're interested in, talking about dance or art or other things. And so I think New York is fabulously well positioned for this. I think you're seeing a huge sort of resurgence in Brooklyn, where there's lots of interesting stuff happening there. And I think that, that it's that lifestyle that is really driving this.
Right. Not too much to add. I'll just touch on what Brad said. I think that's absolutely right. You're also seeing with the young people, instead of coming to New York to be investment bankers, they're coming to New York to be entrepreneurs, and that's happening in droves now. They're leaving business school, engineering schools, looking to start companies, and so I think young people have always wanted to be in large urban areas or urban areas. Now they're able to do that and have success, or have seen patterns of success in others. They're willing to do that, where before they might have taken a safe route. And I think that's just a mind shift, a cultural mind shift that's taken place here over the last 5 to 10 years.
And I think I would agree entirely, and I think another reason for that are the internet, high bandwidth connectivity has just obliterated the traditional gatekeepers, and which usually then drives relationship experience and all the other attributes needed to build a business. And so you have that this first generation that's now coming out looking to disrupt industries and don't have the same obstacles that may have existed in the past.
Yeah.
So maybe just to follow up on Brad, your comment around this urbanization phenomenon, and I'll use the West Coast more, reflective of my question. What we see happening in San Francisco is more akin to what we see here in New York. It's very focused around kind of what I'll call media, internet, e-commerce, and kind of the old traditional, heavy-duty technology is probably still, home of Silicon Valley area. Is at least my perception. So I guess the question is that perception accurate? And is really there a sector of the urbanization, and then there's still, the old core technology that is either changing and is no longer a focus of VCs, or remains the way it was previously?
Yes, I think that's correct. It's chips and routers and infrastructure that's happening down the valley, and it's the applications layer services that are happening up in the city. And it's an interesting problem for VCs, because the chips and routers and infrastructure were a great VC investment for years, because you really couldn't launch a business without investment, because it took you 18 months of R&D before you could release your product. And that was a nice position to be in as an investor. But the problem with that sector right now is it's becoming dominated by large global companies. It's becoming commoditized. It's all a scale business. It's very difficult to launch a VC business in that space. And the VC action has moved to the applications layer, where, as Amish says, you now can get to a global market with literally with 3 or 4 people. I mean, you have app developers who have 3 or 4 people, and are now reaching millions and millions of people around the world. And so that's where the action is. The problem from the VC perspective, which is wonderful for all you entrepreneurs out there in the audience, is that it's a much more capital efficient business. And so, Foursquare got to 100,000 users on $25,000. That wasn't possible for Intel.
Is there a risk that as it moves to these large companies, VCs move away from that, that real innovation may not occur in the kind of the more sophisticated technologies, as these entrepreneurs are able to do it better, and they're able to risk more, as opposed to the larger companies that are always focused on the bottom line? Is there a risk that maybe we lose that innovation edge in some of the traditional technology industries? Anybody here?
I think generally speaking, capital finds its way, and trying to artificially push capital into segments that are not ready for it becomes really difficult and challenging. And so the really smart ones will understand the constraints and figure out new opportunities. What you also find are entrepreneurs that have done exceedingly well going into some of these more difficult or capital-intensive businesses, where they can put their own credibility, net worth, et cetera, on the line and go after much bigger sort of ambitions. So, there is some risk of that, and there is a role for maybe public sector to play in some elements of research, development, things like that. But I think the opposite sort of idea that there's somehow a mandate that's possible that would solve that is also really difficult. And what you really need is fluidity of capital. That I looked at your clean tech slide, and one of the things that went off in my head was, wow, no one's in this anymore. Let's there must be interesting opportunities and interesting ways to approach things. And I know anecdotally through friends that are in other segments, whether it's healthcare and other areas, that they're trying to figure out how to adopt this capital efficient and sort of how do you build quickly, get feedback, iterate, and do that in much tighter loops than they've ever had to before. And I think that's going to lead to more creative solutions in those areas. So anyway, I think the opposite of trying to mandate that becomes difficult.
Okay. There was a slide early on that kind of showed both on a quarterly basis over the last 5 years or so, and then real long-term trend, but really focused in on the last 10 years, where the numbers have kind of gone between 20 and 30 billion a year. And for a variety of reasons, I'm sure it just hasn't been able to kind of get out of that range. Do we have a capacity constraint? Is there a limited or a finite amount of good investment at an appropriate valuation? Is it at 30 billion, if there is one, or is it at a higher number? Is there an ability to really drive more venture funding to innovate, or Amish, as you indicated, is it just capital will find the most efficient way? And so Brian,
so I think a couple questions in there. I think that I'm not going to guess what the proper amount is in any given year for venture investment. But there are some industry-specific things going on within our business, particularly in the LP community, that is impacting what happens to entrepreneurs and the funding that's available for them. If you look at the venture fundraising climate today, or actually over the last few years, and it's continuing, is that you're seeing a lot of very small funds get raised, seed funds. I think most of the first-time funds, I saw it was 50 or 60 first-time funds last year, most of those were below 10 or 15 million in size. So there's very few, I'd call institutional-sized first-time funds getting started in our business, and more of the capital is flowing to a select few firms. So less so here in New York, although there's one or two firms on the East Coast that would qualify, but more so in Silicon Valley. If you look at the 20 billion that's being raised, I think 10 to 12 billion is from 10 firms, and everyone can name those firms, I think, fairly easily. And the rest is going to smaller funds like ours, quite frankly. And I think the good news is that I think that's where the returns are with the smaller funds. Union Square, who could raise a $5 billion fund tomorrow if they wanted to, they've been very disciplined because I think, and I don't want to speak for Brad, they saw the mistakes that happened in the prior decade with some of the funds that raised too much too fast. They changed their model, diluted their talent base, and so I think that there's a new generation of VCs that plan to keep their fund sizes small and not grow it, and you have these very large funds that are operating out there, and the combination of that plus the LP appetite to just fund Fund 12 or Fund 14, and the fact that they can't put more capital into the newer funds is creating a situation where there's a limit to how much can get done every year. There's a lot of demand for these large late-stage deals, and at the early stage, because we keep all of our funds relatively small, there's only so many hours a day, there's only so many investments we can make in a given year, and that will keep a cap on the opportunities that get funded, I think, for the foreseeable future.
But your numbers aren't capturing the angel investment community, and it's not capturing the crowdsourced funding opportunities. And so I wouldn't take it as discouraging that there is a limit to the amount that professional venture capitalists can do, but which is true. because I think there's a lot of really interesting things emerging now that will make up for that, and particularly at the small, low-end, capital-efficient application layer businesses that I would argue are the right thing to be doing right now.
That's a good point. So we don't track angel funding and angel-like funding. What's your sense on that? Is that increased? I mean, it seems as though there's activity, greater activity that I'm aware of now than there was, say, 10 years ago. Is there a sense that has kind of filled a void that maybe as the VCs might have moved away a little bit from that very early stage funding?
I think longer term, yes, it's a long-term trend. There's an overall increase, but I think there's lots of cycles in between there. Personally, if I look at the marketplace today, I see a lower level of angel investment today than I saw maybe 18 to 24 months ago, but in 6 months it might pick up again. We're seeing a lot of angels came into the market the last few years, deployed capital, but they need liquidity to be able to deploy more capital into the investments. It's just like funds. Once you deploy capital, if you can't get capital back, in our case, they're LPs, they won't give you more capital to invest. I think in the case of individuals, the personal balance sheets aren't there to continue to fund things without getting liquidity. So there was a big surge where I think a lot of education happened, particularly locally with angels, where they may put a lot of money to work very quickly personally, and now are licking their wounds a little bit, waiting for capital to come back. And as it comes back, I think they'll deploy it in a smarter fashion. And so long term, feel very good about that segment, helping entrepreneurs and helping to fund entrepreneurs, as Brad said. But it's a learning curve, for sure.
Yeah, the best angels are angels that have built businesses like yours before, and so whenever it looks like it's fast money, it's great opportunity. A lot of people come from a lot of different sectors: doctors, lawyers, real estate people, and they throw money at tech, and that's not a good solution. But if you've got tech entrepreneurs who've had successful exits and they're investing in markets that they understand and people that they know, that's where you really start to build that base. And I think we're starting to see that. I mean, we've had a couple of exits down in New York, and I think we're going to start to see that money reinvested in New York. That'll be good.
Okay. Speaking of exits, our exit slide was not great for Q1, but based on everything I see in the market and our clients, it seems to be pretty exciting. Our clients seem to be gearing up for some type of liquidity event in a manner that I haven't seen in a number of years. Curious if, again, that's just my anecdotal observations, or what's your feeling on exit markets, in particular the IPO view over the next 12 months. Amish?
Well, so I think what you need in the exit markets is a perception of or competitive segments where you have lots of different acquirers who can drive up the value and pricing. And maybe the most recent example of that might be something like Waze, where there were a number of big folks looking to bid on a relatively, I wouldn't say small, but an aggressively bid up a company for all sorts of reasons, because they have such big platforms. So I think you want that sort of a dynamic. You look at Salesforce buying ExactTarget, setting a 10, 11, 12 times run rate revenue multiple. So there are massive shifts that are occurring right now and creating those dynamics. The public offering. So I think you need that backdrop. That's sort of the big carrot that everyone gets excited by. It allows people to create competitive dynamics in markets. It allows pricing to move up. It allows exits to happen, liquidity to flow back into the system by way of angel investments. So I think that becomes really important. The public markets are a little bit different, and I probably honestly can't speak to that directly. But that there are lots of companies that are trying to figure out how they want to tackle that. You have young entrepreneurs who are not necessarily enamored with the idea of running around and kind of dealing with the traditional IPO markets that have existed today. So they're taking a little bit more time before they go into it. They may do things structurally to prepare themselves for it, or they may jump 2 feet in. So it's hard for me to say on the public market side. There are lots of different currents that I think are underrunning now.
Mm-hmm. Brad or Brian, any thoughts on public markets?
I'll just throw out a curveball here. It's not really about public markets, but we're seeing an increasing number of companies that do not want to exit. And that's kind of an interesting model. And we're going to have to work that out as a venture group, because I think that, when you can go directly to consumers and create a large network that disrupts fundamentally an established market, it's often true that there isn't an obvious buyer. When you're just doing incremental technology, then you fold it into Cisco. But if you're disrupting, the finance industry, like Lending Club, for instance, it's not clear that Citicorp wants to buy Lending Club. And so I think you're going to end up seeing a number of companies that remain independent, and some who choose not to go public because they don't need liquidity, or they don't need capital because they're profitable and growing rapidly. And so that's going to be an interesting thing to keep an eye on. And I think more and more entrepreneurs, are sort of making a lifestyle choice. There is happening in that market secondary transactions where entrepreneurs and investors are getting exits without a public offering, which is good, I think, for the entrepreneurs and probably good for the venture capitalists, but may not be good for the investment bankers.
So just following up on that, because we're actually helping a company with exactly that desire is to, and it's the entrepreneur's desire to remain not remain private, not have a liquidity event, and continue to grow, right? The fundamental issue that they'll ultimately face is the VCs require for return with a limited life fund, right? So secondary markets have been more, I think, limited to enable, they haven't been enabling a large exit unless another private equity fund comes in and takes over a position. Is there a solution to that, or is it getting another private equity firm to come in and swap, and or is there some fundamental structure change in the VC industry that would enable that to happen?
Well, so SurveyMonkey story was a good exit for everybody involved, and that was a private equity firm coming in. So there are people that will do that, and there are a bunch of private equity firms out there which, as Brian mentioned earlier on, raised way too much money, and the only way they can deploy it now is to make really big chunks, and they're looking for profitable, growing internet businesses that have good cash flow. And so those deals will continue to happen. Is there another model? I don't know, but I think that there may be a kind of capital that buys out the early sort of growth capital that venture investors do. That would be a more patient sort of income-oriented capital. That if these businesses are cash flowing nicely, then it's a tricky problem because the tax laws don't make that particularly efficient. But there may be, you guys will probably invent something that makes that work.
Really, the best exit is a sophisticated family office. If I had a sophisticated family office, which I'd be trying to do.
But I think the markets are solving this, right? I mean, many years ago, in the early 2000s or maybe even earlier, it was, there was always this perception of if I'm an investor, and I'm not holding my shares, there must be something wrong underneath, and the buying side is, oftentimes getting nervous. And I think that sort of has begun to shift, and for a variety of reasons, and it's starting to happen more and more and more. And at the same time, I think entrepreneurs, to the extent that they take this view that they don't want to go public, are also becoming, whether it's more sophisticated or are seeing examples where people are creating liquidity and some amount of liquidity for their early shareholders. They're also not viewing it as, you're selling in my business. That's a sign that you don't believe, that sort of thing. They're sort of understanding the practical realities of the money flow. So I think there is a psychological shift that is emerging to fill that void. And I think that's going to be a meaningful source, not the source, but a meaningful source going forward.
And I think it's actually good for the entrepreneurs because, quite frankly, once they get to a certain stage where they can think about being fully independent or private, having us around the table is really not that valuable. I mean, as great as we all are, VCs generally, once you have a very mature company, there's limits to how much value we're really providing at that stage of the company's life. We can give advice, but there are probably other people that are better for helping get a business from 1 billion to 10 billion than us. That's not where we spend our time.
Coming back to the IPO question, this time I'm going to turn specific to New York. New York has not had a lot of IPOs, nor have they had a mega IPO. We see Silicon Valley being driven in many respects by these mega companies that were super successful and begin to shed multimillionaires that then form second and third companies. In New York, we've had some success stories, mainly through M&A. Tumblr will be, I'm sure, one of those that will see many, many companies to come, but New York just has been devoid of that IPO. Is there something fundamental in New York? Is it the type of companies or something else?
I'll speak to that. I just think it's time. The exits are getting bigger, they're happening more often, and I think it's just a matter of time before New York. We're behind Silicon Valley for sure. We have a big head start, but I think the amount of time it's taken us to get these sort of fairly large exits is much shorter than what they had initially in Silicon Valley. I think we'll start seeing over the next 5 years a number of companies that are born and bred here in New York having IPOs, hopefully staying independent and becoming true ecosystem businesses. That's what we need. That's the one, that's the one weak point right now for the New York market. We need 2 or 3 companies. We need our Google or our Facebook that can really spawn 100 companies or 200 companies. The closest thing we've had to that was DoubleClick over a decade ago. And
You also had metadata. Still out there.
Yeah, metadata.
Maybe.
But I'm not sure how many companies they spawned.
Yeah, very fair.
Yeah, but so I think we'll see some of that. I mean, we have a portfolio company, AppNexus, here in town, which is growing quickly. We'll see what happens there, but I'd love if they can get there to be a company like that can. I know Brian O'Kelly, the founder and CEO, would love to have a company that's independent and large and was around for a long time.
I think to underscore what Brian said, I mean, if you were to look at, if you had data around median time to exit, you would see this, it's probably 7 years, 6 years, 8 years, depending on the segment, and some of those stretch out pretty long. And if you think about when New York really began to develop the critical mass of an ecosystem, there were early signs in 05, 06, 07, 08 maybe, but things really started coming together in the last few years. And so what you're seeing now are the beginnings of companies that were at the front end of that curve. And as we start getting to the sweet spot, I think that's what's going to come up and surprise people when that happens begins to happen at the velocity that we expect. I mean, we look at the dynamics underneath and see some really positive trends and positive developments.
So I'll take the other side of this argument and say that if you think about the big public companies that have been built in the tech space, the early public companies were all big, broad platform companies, Cisco, Intel, things like that. And then the next wave of big public companies were this applications layer platform companies, Facebook, Apple, Google, Amazon, and I think there's at least a possibility that if you look at how companies will compete with those big platform companies, they are going to have to be more open. They're going to have to be more respectful of their users and their users' data, and in doing that, they're going to give up some defensibility. And so I think it's possible that we're going to have a new wave of companies that will not be as scalable, at least from a profitability perspective. They may have very big networks that are very efficient and very lean. And on top of that, there will be a huge number of smaller companies that are building fabulous businesses, but in more specific vertical spaces. And those companies may not be the best candidates for being public. Which leads back to this earlier conversation of lots of other ways of getting liquidity in those companies. This, by the way, I think is wonderful news for everybody in this room that's not a venture capitalist, because I think that it means that all of these companies can be profitable, all of these companies can be defensible and thrive within their niches, but it's hard to get venture capital returns if you can't build a platform company. And so I think that's the countervailing trend that will balance the stuff that Brian and Amish were talking about.
So if I could just take the other side of the other side. I think there was one qualifier in there that, so I generally agree with a lot of what Brad said. I think the one thing that maybe we have a little bit of a different view on is whether you can build a large company within specific verticals. And I think there's going to be lots of companies that emerge that co-opt technology, redefine a business model within a segment, and actually will create large sustaining size. So, if that doesn't happen and they remain interesting niche, sort of very profitable vertical businesses, that wouldn't be a fair assumption. But what we're seeing, I mean, even in things across vertical CRM and other areas, you're seeing $50, $100 million plus businesses growing 100% year on year that are being created. And a lot of them are also beginning to use data in really interesting ways that were never envisioned when they were created. And so I think I would say that would be the one exit path for the sort of maze that Brad set up, which is these vertical industries that actually might be able to create scale.
I'll stick to what I said. I think we're going to have a number of large public companies here over the next few years. Some of them will be platform companies.
So in thinking about Amish's comments, particularly, if you think about a company like Lending Club will get public, and it's a vertical. So and the financial service industry is not small. So there are obviously examples that fit that pattern, and therefore will get public.
Yeah.
Maybe just following on that one, and I think we touched upon a number of companies. Hot areas in New York, if you're starting a company, what do you think entrepreneurs should be focused in on that will catch the attention of VCs over the next couple of years? Anything in particular?
So I really find that question just to be a very difficult one, because if it's a hot sector, it's an obvious sector, which means that you're already playing from behind. I think if you look at most of the segments where at least we've seen success in companies growing out of areas, have generally been things that have been non-obvious, non-intuitive to a lot of folks at that point in time. I'm sure Tumblr represents a great example of that. If someone would have said many years ago microblogging was going to create $1 billion company, wouldn't necessarily resonate with everyone sort of in the room. And I think that's true across a variety of interesting things that we've funded, whether it's Pinterest and kind of changing sort of that visual medium on the internet, to Lumosity and brain games, to Aereo in creating broadcast TV in the cloud and trying to create some shake-ups in large industries. So the hot segments are generally the ones that are reported on, well covered, that investments have already kind of been made in, and that becomes kind of a tough way to jump into a segment as an entrepreneur. It's sort of the non-obvious things where people aren't necessarily looking that I think are the most interesting opportunities.
Yeah, I would agree. I think hot, I don't love the word hot.
Let me rephrase my question, because I probably shouldn't. I said, what are the non-obvious sectors that we don't know about, but that you have insight to as VCs that you think will be hot in the upcoming years? That's.
I actually think we're living through an unusual time where there isn't. I think a lot of it is very obvious, quite frankly. 15-year-olds come up to me and talk to me about companies they're thinking about, and they're good ideas and they're focused in good sectors. And just look around, everything. One of the reasons why New York is really exploding is because this is the center of so many large industries, and pretty much every single one of them is being massively disrupted as we sit here right now. And so we're seeing opportunities, quite frankly, in every sector, whether it be healthcare, education, financial services. There's not a corner of the economy right now that's not being impacted by what we talked about earlier, the power of computing, cheap computing, ubiquitous, everyone with 10 devices. And this is just historians will look back at this period like a Renaissance period, post-bubble busting in 2000, and say the 50 years that we were living through right now is just going to be an amazing amount of innovation. And so it's one of these weird periods where I don't think you need to look for not obvious things. I think you need to look for the right opportunities within those sectors that people, before others are searching for them. I'm not going to talk about how we think about that up here, but I think that in general, there's opportunity in every sector of the economy, pretty much across the board.
What's wonderful about what Brian just said is that he didn't say big data, he didn't say mobile, he didn't say internet, he didn't say a tech definition, and that's really the case right now, right? I mean, it's what is interesting is the disruption that's possible of existing industries, and so it's much more interesting to think about that than it is to think about a tech categorization.
I get my mind blown every day. I walk into the office or go visit a company, and I'm like, wow, it's amazing what they're trying to do just to upturn the industry upside down, and it's happening. It feels like every day.
Can I give a public service?
I'm sure you guys all
real quick. So one of the I'm completely convinced that this is where the opportunity is. It's disrupting these existing industries. But I'm also completely convinced that the existing industries are doing a really good job of defending themselves, not by making better products or better experiences for consumers, but by going to Congress or the City Council and asking to prevent a new taxi service from arriving on the scene, or a new housing service like Airbnb from arriving on the scene. Or I heard this great one today, and I'd kind of forgotten this, but that there are laws being passed in various parts of the country that would make it illegal for for a municipality to offer fiber to their citizens, because they would be competing against the private sector players in that space. And so it's just example after example of very well-funded industries, existing incumbents, great relationships with the policymakers who are passing laws. If you look at the Airbnb law here in New York, it was passed before any single city council person knew what Airbnb was. But the hotel lobby that proposed the language knew exactly what Airbnb was, right? And so that kind of thing is happening all over the place. And we, who are going to benefit from all this, either by creating it or by consuming this innovation, have to be aware of that and have to, have to support the freedom to innovate.
It says something about the level of disruption innovation when they have to resort to those methods. It's like almost a last resort to have sustainable businesses. And protect their monopolies or oligopolies. I think in some ways it's a positive thing. It just shows you what's possible, that they need to go to government to protect themselves. When usually it's the little guy who needs to do that.
Well, I have one last question, then we'll open it up for a few minutes to the audience. Brad, you mentioned crowdfunding early on. It was something I did want to come back to. I've heard of it. I'm familiar with a couple of companies that do it, but I haven't seen it necessarily in action with respect to funding investment in a company, traditional investment with return. Am I missing that? Is that happening right now? And is it working, or are there kind of legal constraints, primarily because of the potential for fraud, that will kind of skid the wheels on that?
So it is happening. It's an area that is really pretty scary in a bunch of ways, because we're investors in Kickstarter, and Kickstarter is sort of, everybody calls, that is the original crowdfunding company, and they talk about Kickstarter for this, Kickstarter for that. Those guys are panicked about watching the emergence of crowdfunded equity, because when you contribute to a Kickstarter campaign, you are making a contribution. If you get a CD in the mail, great, but otherwise you're just supporting the arts, and you don't have any expectation of returns. When you start to add an expectation of returns, then you're going to start to add lawyers and lawsuits and all sorts of ugliness to what has been a really phenomenal thing, very generous thing. And so I think what you're seeing, first of all, is you'll see more and more lending, and that's debt, not equity. And we're investors in a couple of those platforms. And then I think you'll see equity. The right place to begin to see equity is in stuff that's far away from tech. Things like a new soft drink, or soft drink wouldn't be the right answer, but a new iced tea or something, and or a new food product. Those are things where people are going to be consumers. They're going to understand it. The entrepreneurs are going to be local. They're going to be building the businesses locally. Those are the things that I think we should be looking for first of all, not the big tech plays.
Great. So with that said, let me open it up to the audience. And first question, right there. Yep.
Hi, thank you for this great discussion. Learned a lot. You mentioned the whole kind of thing regarding laws being passed that can work against startups that are kind of pushed back to innovation. Forgive me because I can't be very specific, I don't remember this, but a couple of weeks ago I saw an article about kind of a consortium of startups on the West Coast that are banding together. Tell me if you know what I'm talking about, please. They're banding together against a particular piece of legislation that's affecting them. If this doesn't sound familiar.
Well, there's a whole bunch of things going on. There's right. The most visible one is actually a bad example. It's Forward.us, which was started by Mark Zuckerberg at Facebook and a couple of other folks. And they've really focused on sort of the plumbing of the startup scene, things like getting talented engineers into the country and that sort of, those are problems that are generic. The more interesting one is the one that's, I forget exactly what it's called, but it's being spearheaded by Airbnb, and it's called the peer economy or something like that, and they've recruited a group called Purpose to help them, help them publicize that. One of the problems with that is that it's a little bit inauthentic. I mean, I really respect what they're doing, but there's a term, and one of the great things about this is I'm learning a lot about politics. There's a term in politics called astroturfing, which is trying to make something seem like grassroots that isn't grassroots, and there's a little bit of that in there. And I think we're much better off with each individual network reaching out to its users and saying, is this a service that you want? And if so, you're going to have to make your voice heard. That worked really well for Uber in Washington, D.C., and I think it's going to work well for others. But it's a really interesting set of problems.
What, business in an early stage investment, I know that you mentioned Amish in early stage, and I'm not sure.
We all do. Yeah.
That's great. What stage do you, what would bring you to the table with a business, and what kind of information makes you salivate to then further the discussion and figure it out from there, whether it works for your company or not?
So the secret sauce. No, I think there's never one obvious thing. I mean, if I were to look at my own portfolio of what caused me to get over the goal line, there's a whole sequence of things, and frankly, me getting over the goal line is probably a too presumptive a way to say it. It's a mutual process of courting to get to the altar. It's probably a better way of putting it. And so, the obvious answer is up and to the right is always interesting, but it's really interesting sort of user behavior that you wouldn't have guessed, unintended consequences, unintended effects by launching a service. That becomes really interesting. And then the other piece of it is kind of team generically, but also unique insights on a market that a team is pursuing. So, I think it's really difficult to sort of bolt on the pain or the passion of a segment. I think a lot of the best things that we've been involved with have sprung from a passion that's deep within, that has been experienced, that kind of one saw out there, learned from, and then built behind. And so it's a combination of all of those within the backdrop of a deal structure that sort of makes sense. And that's a pretty organic walk, and there's lots of different ways that one can take that. But that's probably not helpful, but that is the reality of a lot of the things that we wound up doing.
There was an embedded assumption in the way Amish answered that question, which I'm going to try and draw out, and that is that he talked about up to the right, user growth, blah blah blah. He's assuming that your product is in the market that's launched. And one of the biggest turnoffs, I think, for any venture capitalist is somebody shows up at their door with a 30-page plan and says, if you fund me, I'll quit my high-paid job and go do this. Because that is, that's basically saying, oh, so it's our money that's going to create this company, it's not you that's going to create this company. So if you don't have the passion to go do it, now, you have to have a really good excuse. There may be some areas where, if you're going to do, some kind of huge energy project or something that has to be financed before you can build it, but certainly not in the internet space. You can do it and then go look for the funding.
Yeah, I'd agree. I think it's team and passion are number 1, 2, 3 for us. And then from there, it's really just uniqueness and swimming big. I think there's the one thing New York, I think, suffers from maybe more than the West Coast is and it's changing, thank God, is just thinking too small. And I think as the successes have gotten bigger and bigger here, we're starting to see the entrepreneurs thinking bigger and bigger. And so just the way we've designed our firm, I can't speak to the others, is that we really are looking for truly differentiated transformational companies. And as a result, we've passed on a lot of investments where we thought we like the entrepreneur, we like the business, it's nice, but just wasn't really compelling from a capability to be really unique, 100 times better, something very different than what we've seen before.
Just one other comment, sorry.
Yep.
One other thing to add on that may be useful. I think it's really critical for an entrepreneur to have as good a relative lens as they can possibly have, which generally comes from what Brad described, really smart angels who understand a segment in the sector. I mean, if you were to think about starting a content company, an internet content company, 7 years ago it may have been 250,000, 500,000 users. That was really interesting. As you fast forward in time, that bar of what's relevant has gone way up, and that's true across a lot of segments. And so, a lot of folks come in the door. It's really hard to have the same breadth that we see across a landscape. And so understanding where you are in a relative context becomes really important, because you may, that is also really important as you try and get Brad's attention, and you say, hey, I have 10,000 users. Brad says I have 10,000 friends. So it's individually, right, that I'm connected to. So I think having that sensitivity to where the relative baseline is becomes really important, and then you can begin to differentiate as to why your service is so interesting.
And if you haven't launched, it's why are you then unique? Because then you don't have numbers.
Yeah.
And it's why are you uniquely the right person to disrupt this industry or innovate in this fashion? Why is it you versus someone else? And that's what we look to. So what is it about that entrepreneur that makes them uniquely qualified to tackle that big opportunity?
And I'll just add one last thing, because I'm trying to go from what was Cloud9 maybe down to Press. I often find that when you look at whether it's someone's product or wireframes, if you're pre-launch, so much of how they think about an industry gets embedded in that wireframe or product or whatever it is. It's the physical manifestation of what is in someone's head, and that to me is also critical when I think about, or we're talking to entrepreneurs, because you want to hear something that's really different, or a thought process that really sort of hangs together, and how that UX works. So that's kind of another thing that I invest in time in.
Question here?
I've done this internet thing since 1993, and one of the things I found, I was the one who originally bought Monster, and my question really is, how do you take a disruptive company, which it really was, and stop it from becoming irrelevant? Because, Monster went from 0 to 3 or 4 billion, and now they can't give it away.
So I would say see Jeff Bezos. That's like my answer to that question. Is the way he runs Amazon. I'm just amazed. I think Jeff Bezos is just incredible. The way he runs Amazon is he sets up. I know a bunch of people that work there. He sets up independent teams within Amazon, funds them like startups, and tasks them to destroy some part of his business because he knows someone else outside of his company is doing it right then. I think that's really, outside of doing that, very hard, because people come into large organizations, they're trying to advance, they're not really thinking about innovation the same way. So unless it's from the top and you have a system in place to continue to innovate, Google tried it with the whole 20% of engineers' time on something else. But I like Jeff Bezos' idea, which is, do a startup within the company, put them somewhere and say, go destroy your colleagues' business. It's a good model.
Good question. Got time for one more in the back there.
Looking from the international perspective, what's the take on international markets, both in Europe and Latin America, on the investment opportunities, and then also local businesses, the risk?
Can you repeat the question?
Yeah, I think the question was our take on international markets, both from a startup perspective and from a VC's perspective in those markets. I don't really know too much about Latin America or Asia. We've made a number of investments in Europe. I think that the startups in Europe are, particularly at the applications layer of the internet, are starting to push out ahead of the venture capitalists there. I think the venture capitalists in Europe have traditionally been a little bit more cash flow oriented and looking for more evidence before they make an investment. And so I think the startups, though, I think there's a couple of really interesting things coming out of London and Berlin, particularly, that are going to be global companies. And so I think that's about all I can help you with.
I think we're out of time. I'd like to thank our panel. You guys lived up to your expectations. It was a great discussion. Please join me in thanking them.